Good morning. This is Axel Merk, President and Chief Investment Officer of Merk Investments, with my now daily morning briefing in these unusual times. Those unusual times may well be unusual for an extended period, as you're well aware. In California, for example, our shelter-in-place order has been extended until the end of April, I believe May 3rd even. I would have thought that maybe some refining in these rules are going to come into place. That does not appear to be the case. At this stage, the rules are obviously state by state in the US. The question has been asked of the president why he doesn't just do a blanket rule that everybody has to shelter at home and so forth. In my view, it's absolutely the right thing to leave it up to the states because you do need to have a more refined approach to it. And indeed, I wouldn't mind if it started to be more refined within the state. Not necessarily that county by county, but as far as the sort of things that one can do. But because there are certain types of businesses that one could try to get started again. Let's see at what stage we get that. Cuomo had said that's the governor of New York, had said that we can open things up once we got the rapid testing at home. Well, that's not going to happen overnight, even if such a test apparently has been developed, but deploying that, figuring out how this all works, that's going to take many weeks. And on that note, let's talk about the jobless claims. Obviously, record numbers, some devastating numbers. Companies are in emergency mode, and the previous week, maybe not everybody was able to register. A lot more fallout as people see that the bills are coming due at the end of the month. They stop paying rent and whatnot. The real question is really what's going to happen at the tail end of this from an economic point of view. Are these people going to get their jobs back? This morning, somebody on Bloomberg Radio had said that about he thinks half of them are going to get their job back right away. The rest is going to be much slower. We're all just throwing out numbers here. I don't think anybody knows exactly how this is going to work. But clearly, if somebody is out of business, you can't just restart that business. And there's the old saying, when the tide goes out, you see you swimming naked. Well, you don't need to have been naked to have been whacked by this crisis. And so obviously, if somebody has been strong, then the lenders are more likely to work with you. There's obviously numerous government aids and so forth, community helps, private sector help available. But if you were weak in the first place, then odds are that things will be shut down. I'm based in Silicon Valley here. There are lots of stories about startups not being able to raise money. If you need to raise money in this environment, it's difficult. Incidentally, I have a daughter who decided to drop out of college to start a startup, and she got some funding, not large amount, but certainly for the scale of little business that she has, it's a good chunk of money, and that's because it is something that is appropriate and suitable for the current environment, and so then there is money around. So companies do have money for investing in certain things, but for a great, and of course that has ripple effects, right? And not that everybody's going to have pity with Bay Area real estate prices, for example, but it may well have an impact in that neighborhood as well. More broadly speaking, of course, the hardship that's on many people who were living paycheck to paychecks, and now not only don't have those paychecks, but don't really have an alternative because they're not allowed to work because the employers are out of business. The employers themselves needed to do this. The big challenge here is really the small business. Often people refer to companies with fewer than 50 employees. Usually you don't have access to the lending markets and whatnot. And so there are several government programs out there, but especially the ones who don't have a buffer, of which there are many businesses. I mean, don't have a challenge. And there one difference between the US and other countries, most European countries, for example, they are injecting the money on the corporate side in the sense that if you keep your employees, do not lay them off, they subsidize part of the compensation. And the idea here is that if you don't lay somebody off in the first place, it's not as difficult to get them back. Now, for the time being, that seems to be the less destructive approach. The flip side of, by the way, of unemployment insurance is there have been some people that have criticized that, hey, the government is now giving for at least 4 months this high unemployment insurance. Some people will get more than if they made minimum wage. The incentive to go back into the working world is going to be reduced. Now, obviously, the Wall Street Journal op-ed had indicated that. That, of course, is considered cruel in this environment. Just looking at the economic kind of impact without the human impact of that, it remains to be seen how this plays out, because if indeed only quote unquote half the people will get the job back when the economy opens back up, then maybe having that additional buffer isn't really deterring people. It's just that there isn't enough infrastructure there to get them back up and running. But yes, incentives do matter. And it's part of the reason why it's important to get red tape cut in this sort of environment, not just for anything that's absolutely necessary to respond to the crisis, but beyond that as well. The red tape has really inhibited job creation in this environment. In my view, if you look at the 10-year yields around the globe, when they are near zero, it's a testament to the regulatory and tax environment. If you think that you cannot get rewarded and compensated for, and rather get in Europe negative yields in some countries, or very low yields anyway. Now the 10 years, I speak here at 60 basis points. Obviously, it's a unique situation, but even before that, yields were quite low. That's really a verdict on the regulatory and tax environment, that people think they're not going to compensate it, and that maybe that there's too much red tape. Why do you invest in social media companies and don't invest in big infrastructure projects? Well, because the burden of deploying those projects is just too high. The other aspect, of course, could be that government debt is very high, and the government is going to go and tax you somehow, somewhere. Now, again, that's not the problem of the day. I suppose we have bigger issues, but if we want to get this economy up and running and rolling again, we do have to worry about some of these things. Then just one other comment here on, and by the way, while I talk, I should show you some disclosure. So let me blend that in here. Higher education is going to suffer dramatically. There hasn't been much in the news on that. As everybody is aware, higher education has been extremely expensive, overpriced. Bubble is what's come up. If you are one of the best known institutions, obviously you have an endowment, and there's a lot of aid provided to students, but not everybody is the top school as far as financial resources is concerned. Fixed costs are rather tremendous. If you have a nice campus, it takes a lot of money. A lot of these schools have provided refunds when they've sent their kids home. And so they are struggling themselves, and donating to schools is probably not the first thing that comes to your mind when you think about how you're going to allocate your own precious resources in this sort of environment. And so that's going to be a fallout that we may not see in financial markets, but that we'll see way beyond that. Other than that, I sent out I like to send out these miniature surveys just for a few hours. I asked them how many have fallen into what they might consider routine, and a significant number, more than half, indicated, I think it was about 2/3, that they have, and that's kind of human nature. We fall into routine, and that's important because we get less stressed. We figure out how to do things. By the way, the reason I look above here the camera all the time is because my Bloomberg terminal, I've set it up, is above the camera. I'm trying to tell you something you don't know. But the one thing, of course, I see that the market, after having dipped to negative territory, is back positive. And the big question remains, have we seen the lows in the markets? And I don't have a crystal ball. I know as little as anybody on this. It seems that that it would be very surprising that that this has all been priced in already, and we are recovering already. But then again, let's also keep in mind, the market is a discounting mechanism. The S&P in particular, and none of this is investment advice, is reflecting the largest companies that have probably better resources to get through it. The one thing I'm concerned about is the consumer. When you hit a wall like this, and I say when, it has not happened like this in history before, but my assumption is that people are going to be spending less. Right now, of course, the people, not of course, but many people are spending less because you have to hang out at home. You're not going to go on that vacation. You're probably not going to buy that car and other things. Is this all going to snap back? Are you going to buy that car right away? There's been a lot of wealth destruction. A lot of people don't know where their job is. The biggest internet companies based on advertising revenue. Well, that's a cyclical business. The reason why they have done well despite anything is because they've just been gaining market share. Well, sure, maybe that trend is even going to accelerate. That's going to be bad for brick and mortar stores, but in the current environment, they may also be suffering. Now, that said, these are long duration assets, and especially with low interest rates, you can discount those future cash flows more. So there are lots of arguments made as to why we may have seen the bottom. I personally don't buy it. I also always glance at gold a little bit. We do a few things in that space, as many of you do know. And by the way, as you may have noticed, I don't talk about products on these calls, but we are at 1611 on the spot gold, and that had a significant downdraft on the 31st of March, end of the month. People squared their books. There was a lot of oddities in the squaring the books. There's a rebalancing taking place as well, and it takes a few days off until after the end of the month for things to normalize. But in any case, these very bad numbers, and for what it's worth, people in the media and try to interpret what's happening in the markets with the news of the day. And that's, of course, very dangerous because the markets move for all kinds of reasons. And we like a story, the prominent headline. But sure, that may be part of the story. But with that caveat, let me point out that the reason why gold might move higher on a day like this with the initial claims being so bad. Bonds, by the way, don't move much right now, but they might be, because it might suggest that this downturn might be more pronounced. And even though we have kind of stabilized financial conditions in the sense that spreads are tighter, liquidity is better. Liquidity isn't good yet in many markets. It's not deep. That is maybe something important to say. You see prices spreads when you see them. The quote in the market is okay, but anybody who places large orders could be in for a surprise, and not just could be. We see in some of the markets, currency markets in particular, people placing large orders get whacked with suddenly the spreads widening quite substantially. But in any case, usually what happens is that after the initial crisis, the liquidity fear, there's the policy response. And the policy response, being a very active one, is historically one that's favorable for the price of gold. Now, with the caveat, of course, after 2008, gold went up and up and up, and then at some point it was overdone, right? And then it had several years of a downturn. I think we're a few years away from that. But again, this is not investment advice because ultimately, we can look at many things, but we just don't know what the future will bring. Other than that, I'm looking here at a few things. I'm just looking at 3-month LIBOR being at 145. That's actually quite high. The effective funds rate is at 5 basis points. I'll look into that, whether that is accurate, but that would suggest that there's still some tension here in that market. Anyway, I will leave it at that. I am hosting well, it's the second time this week. Maybe it's going to become the weekly, a roundtable discussion on Thursday evening at 5 p.m. Pacific time. That's 8 p.m. Eastern time. If you do want to participate in that, it's kind of a very informal open session. Do go to our website, merkinvestments.com, and submit a request. I'm not going to post the open link on social media, so you have to specifically ask to be added to that, and it's going to be a comparatively small group. Anyways, with that, stay healthy, stay safe, and I will talk to you hopefully soon. Bye.